I learned early, by paying tuition to the market, that the biggest enemy of a trader is not the market itself. It's the itch to do something. The desire to be in the game every minute. I used to think that activity meant intelligence. That if I wasn't trading, I wasn't thinking. But the market cured me of that notion, and it cured me thoroughly. You see, the market does not reward motion. It rewards correctness, and correctness doesn't show up every hour or every day. It shows up when conditions line up, when the tape speaks plainly, and when the price confirms what your judgment has already suspected. How often does that really happen? Be honest with yourself. Most traders fail not because they lack brains, but because they cannot sit still. They confuse opportunity with frequency. They believe that more trades mean more chances to win. But the market doesn't work on chances, it works on probabilities. And probability improves when you wait, not when you rush. I made my real money by sitting, not by trading. Sitting tight while others were busy losing. Does that surprise you? It shouldn't. The big money is never in the buying or the selling, but in the waiting. Yet how many traders do you know who pride themselves on patience? Every trade you take carries risk, and every risk must earn its right to exist. If a trade doesn't offer you a clear edge, one you can explain in plain words, then why are you taking it? Is it because the chart is speaking, or because you're bored? The market is open every day, but opportunity is not. That distinction cost me years to learn. I would stare at the tape, looking for action, and the tape would give me exactly what I deserved: confusion. When nothing is happening, the market is telling you something. Are you listening? A trader who trades less is forced to think more. He studies the general trend. He watches how prices behave after advances and declines. He notices whether reactions are shallow or deep. He waits for the market to tip its hand. And when he finally acts, he acts decisively, not nervously. Overtrading is usually disguised fear. Fear of missing out. Fear of being wrong later. Fear of not being involved. But the market does not care about your fears. It only reflects your discipline back to you in dollars and cents. I've seen traders make 10 trades a day and call it experience. But experience is not repetition, it's understanding. One well-chosen trade, taken at the right time, teaches you more than 100 random ones taken out of impatience. Wouldn't you agree? When a market is trending properly, it gives you time. Time to enter, time to add, time to sit. If you feel rushed, you are probably trading noise, not direction. The big moves do not begin with excitement, they begin quietly, almost unnoticed. That's why so few are positioned when they matter. Trading less forces you to respect your capital. Money is your inventory. A merchant doesn't throw his goods into the street just to feel busy. He waits for customers who are ready to pay his price. Why should a trader behave any differently? The chart is not there to entertain you. It is there to inform you. Every bar, every swing, every pause tells a story. But stories only make sense when you read the whole chapter, not when you jump from page to page. Are you giving the market time to finish its sentences? I learned to ask myself one question before every trade. Is this a position, or is this a reaction? If it was a reaction to a headline, a sudden tick, or my own restlessness, I stayed out. Reactions are expensive habits. The fewer trades you take, the easier it becomes to manage yourself. Your emotions calm down. Your judgment sharpens. You stop needing to be right every hour. You start caring more about being right overall. That shift alone separates the professional from the amateur. Many traders think the secret is finding more setups. The real secret is rejecting most of them. A good trader says no far more often than he says yes. And when he finally says yes, he knows exactly why. Losses are part of the business, but unnecessary losses are optional. Every poor trade leaves a mark, not just on your account, but on your confidence. Protecting your confidence is just as important as protecting your capital. Do you trade in a way that builds it, or chips away at it? I never felt regret for the trades I didn't take. I only regretted the ones I took without proper reason. The market will always be there tomorrow. Will your capital? Trading less also teaches you humility. You stop trying to outsmart the market and start aligning with it. You accept that you don't need to catch every move, just the right ones. And strangely enough, when you stop chasing, the good trades seem to come to you. A man who trades every wiggle is a man arguing with the market. A man who waits is a man listening. Which one do you think the market rewards over time? Your job is not to predict. Your job is to observe and respond when the odds tilt in your favor. That tilt doesn't happen often, but when it does, it's worth waiting for. Anything else is just motion without progress. So I learned to let the market come to me. I learned to trade less, think clearer, and respect the moments when nothing needed to be done. And that discipline, more than any clever method, became the foundation of lasting profits. Because in the end, the hardest trade you'll ever make is the one where you do nothing at all. Every trade must earn its place, most don't deserve it. That idea sounds simple, almost obvious, yet it runs against the natural instinct of nearly every trader who comes into the market. When money is on the line and the screen is alive with movement, the temptation is to believe that every fluctuation is an invitation. But the market does not invite, it tests. And if you answer every test, you will eventually fail one that costs you dearly. A trade is not something you take because you can. It is something you take because the conditions demand it. That distinction is everything. I learned that a trade should feel heavy before it is placed, not exciting. Excitement is usually a sign that the trade is feeding the ego, not the account. Have you noticed how the trades you feel most eager to take often require the most explanation afterward? Most price movements are meaningless. They are the market breathing, stretching, adjusting its balance. If you step in front of every breath, you will exhaust yourself long before the real move begins. The professional trader learns to separate motion from meaning. He waits for price to reach a level where the market must make a decision, not where it merely passes time. Every trade you place competes for your capital, your focus, and your emotional energy. That competition should be fierce. Only the strongest ideas deserve to survive it. If a trade cannot justify its risk clearly, if you cannot explain why you are wrong before you explain why you are right, then it has not earned its place. Would you stake real money on a thought you can't fully articulate? The market is full of near misses that look convincing in isolation. A small breakout here, a minor pullback there. But isolated signals are cheap. They appear everywhere. What matters is alignment. Trend, structure, volume, and time must agree. When they do not, the trade is not wrong. It is premature. And premature trades are often indistinguishable from bad ones. I learned to treat my trading account like a boardroom, not a casino. Every trade had to make its case. Why now? Why this price? Why this direction? Why this size? Silence in response to any of those questions was grounds for rejection, and rejection became my most valuable skill. Most traders believe their problem is missing opportunities. In truth, their problem is admitting too many unqualified ones. They open positions the way others open conversations, out of habit, boredom, or the fear of missing out. But the market does not reward sociability. It rewards precision. How many of your past losses came from trades that felt unnecessary even as you entered them? A trade that earns its place usually feels uncomfortable in one specific way. It requires waiting. Waiting for confirmation. Waiting for price to come to you. Waiting while others act. That waiting filters out weak ideas automatically. Weak ideas cannot survive patience. They demand immediacy. Risk is not something to manage after you enter a trade. It is something to eliminate before you ever place it. If the structure is unclear, if the stop is arbitrary, if the reward is vague, then the trade is already flawed. No amount of hope will repair it once you're in. Hope is not a strategy, it's a confession. When you trade too often, you lower your standards without noticing. The mind adapts to frequency. What once seemed reckless begins to feel normal, and normal behavior repeated long enough becomes identity. Soon you are no longer a trader who chooses. You are a trader who reacts. The market does not require you to prove your intelligence every day. It requires you to protect your capital until intelligence is actually needed. A good trade stands out from the rest. It has weight. It has clarity. It reduces questions rather than creating them. If you feel the need to watch it every second, it probably never deserved your attention in the first place. I learned that saying no to trades builds strength the same way lifting weights builds muscle. At first it feels restrictive. Later it feels natural. Eventually it feels necessary. You stop looking for reasons to trade and start looking for reasons not to. That shift changes everything. Capital is finite. Opportunities are selective. The market does not care how ready you feel. It only cares whether the moment is right. Most moments are not. Accepting that truth is the price of longevity in this business. The best setups appear rarely, but they speak clearly. That truth took me longer to learn than any pattern or rule I ever studied. In the beginning, I believed the market was constantly offering chances and that my job was to catch as many as I could. I mistook movement for meaning. I thought noise was opportunity. The market corrected that belief with consistency and with cost. A real setup does not whisper. It does not require persuasion. It does not need to be defended once you see it. When the market is ready, it announces itself through price behavior that is orderly, deliberate, and unmistakable. The problem is not that good setups are hard to spot. The problem is that most traders are too busy to notice them. A clear setup usually forms while the crowd is distracted. It develops slowly, often boringly. Price tightens. Volatility contracts. Reactions become smaller. The market stops arguing with itself. That quiet is not emptiness, it is preparation. But boredom is uncomfortable for most traders, isn't it? Most traders are trained by their own habits to expect constant stimulation. They want fast movement and frequent signals. So when a proper setup is building, they ignore it because it feels dull. Then, when the move finally starts, they chase it late and uncertain, wondering why the market feels so hostile. The best setups do not require prediction. They require recognition. They come after the market has already shown its hand. Trend establishes itself. Corrections respect structure. Volume confirms intent. Nothing feels forced. Everything aligns. When you see that alignment, you don't feel excitement. You feel relief. Clarity in the market produces clarity in the trader. When a setup is real, your decisions simplify. Entry makes sense. Risk is defined. Time is on your side. You are no longer negotiating with the chart. You are responding to it. Have you ever noticed how the best trades require the fewest adjustments? Rare setups also protect you from yourself. Because they don't show up often, you are forced to wait. Waiting slows the mind. It reduces impulsive behavior. It gives you space to observe how price behaves without your money involved. That distance sharpens judgment. Most losing trades come from setups that almost worked. Almost strong enough, almost clear enough, almost aligned. Those almost trades are expensive because they feel justified. They give you reasons, and reasons are dangerous things in trading. A real setup doesn't give you many reasons. It gives you one strong one. The market is trending, consolidating, and preparing to continue. Or it is topping, distributing, and failing to advance. Whatever the case, the story is coherent. You can explain it without reaching. When you trade rare setups, you stop feeling pressure to be clever. You don't need to outthink the market. You simply need to stay patient long enough to hear what it is already saying. And the market always speaks through price first, not through opinions or forecasts. Many traders confuse complexity with depth. They pile indicators onto charts, hoping clarity will emerge from clutter. But the best setups strip things down. They reduce information rather than add it. The cleaner the picture, the louder the message. Rare setups also tend to give you time. They don't demand immediate action. They form bases, ranges, and patterns that allow preparation. You know where you are wrong before you enter. That knowledge is not comforting to the ego, but it is essential to survival. I learned that if I had to convince myself to take a trade, it wasn't ready. Conviction should come from the market, not from inner dialogue. The moment you start arguing in favor of a trade, you've already lost your objectivity. The market does not reward effort, it rewards alignment. And alignment does not happen often. That scarcity is not a flaw, it is the design. If good setups were frequent, discipline would have no value. Rare setups teach selectivity. They train you to observe without acting, to accept that most days are meant for study, not execution. That acceptance removes frustration. You stop blaming the market for not offering you anything. You understand that doing nothing is part of the process. When the right setup finally appears, it feels different. The chart looks obvious in hindsight, but only because you waited long enough to see it fully formed. The entry feels earned. The risk feels reasonable. The trade feels necessary rather than optional. That necessity is what separates a professional trade from a hopeful one. Hope enters when clarity is absent. Clarity removes the need for hope. And when hope disappears, discipline takes its place. The market does not shout often, but when it does, it speaks in price structures that repeat because human behavior repeats. Fear, greed, hesitation, and confidence all leave footprints. Rare setups are simply those moments when the footprints line up clearly enough to follow. You cannot force those moments. You can only prepare yourself to recognize them. That preparation is quiet work, chart reading, review, observation, and most of all restraint. Overtrading turns opinions into expenses. That lesson is learned slowly and usually expensively. In the beginning, a trader believes that having an opinion is the same as having an edge. If price ticks up, he has a reason. If it ticks down, he has another. Before long, every thought becomes a trade, and every trade becomes a bill sent directly to the account. The market does not charge you for being wrong in theory. It charges you for being wrong with money. That difference is everything. Opinions are cheap until they are acted upon. The moment you press the button, your opinion becomes a position, and the market begins to judge it without mercy. How many times have you paid for a thought that should have stayed unspoken? Most traders don't realize how opinionated they are. They read headlines, watch price for 5 minutes, and decide what should happen next. That should is dangerous. The market has no obligation to agree with you, and it rarely explains why it doesn't. When you overtrade, you are constantly trying to impose your view instead of observe reality. Every unnecessary trade is a tax on clarity. The more opinions you express through action, the noisier your judgment becomes. You stop seeing price for what it is and start seeing it for what you want it to be. That's when small losses pile up, not because the market is hostile, but because the trader is impatient. I learned that the market doesn't mind opinions. It ignores them. What it responds to is positioning, and positioning should be based on evidence, not commentary. If your trade exists only because you think something looks like it might, then you are no longer trading. You are speculating on your own imagination. Overtrading often disguises itself as confidence. The trader feels active, decisive, involved. But confidence that requires constant action is usually insecurity wearing a disguise. Real confidence can wait. It doesn't need to prove itself on every price bar. When you trade too often, you blur the line between analysis and impulse. The chart becomes a canvas for your beliefs rather than a record of supply and demand. You stop asking what the market is doing and start insisting on what it should do. That insistence is expensive. An opinion that is not backed by structure, trend, and confirmation has no business risking capital. Thoughts are not trades. Ideas are not positions. The market only recognizes commitment, and commitment without alignment is punished sooner or later. One of the hardest habits to break is the urge to comment with money. Price moves, and you feel compelled to respond. But not every movement deserves acknowledgement. Silence, in trading, is often the most professional response. Can you sit quietly while the market moves without you? Overtrading also erodes accountability. When too many trades are placed, each one matters less. Losses blend together. Mistakes become harder to identify. You no longer know which trade failed because of poor judgment and which failed because of normal risk. Quantity buries responsibility. I learned to ask myself whether a trade was expressing an opinion or following a fact. Facts show up in trends, ranges, breakouts, and failures. Opinions show up in anticipation and prediction. One is observable. The other is personal. The market only rewards the first. The more you trade your opinions, the more emotional the process becomes. You feel attacked when price moves against you, validated when it moves your way. That emotional swing has nothing to do with good trading. It has everything to do with ego. Overtrading turns the market into a debate. Each trade becomes an argument. Each loss feels like being proven wrong. But the market is not a debating partner. It does not respond to logic. It responds to order flow. Arguing with it through repeated trades is like raising your voice at a scale hoping it will change your weight. A disciplined trader treats opinions as hypotheses, not commands. They are tested quietly, not enforced loudly. Most opinions fail the test of time. That is why they should rarely be given the power to move money. When trades are fewer, opinions lose their urgency. You stop feeling the need to act on every thought. You begin to observe which ideas persist and which fade. Only the persistent ones, supported by price, deserve capital. The cost of overtrading is not just financial, it is mental. It creates fatigue, doubt, and frustration. It makes the market feel unfair when, in reality, it is simply responding to undisciplined behavior. Would you trust a business manager who made a decision every 5 minutes? I found that when I reduced my trades, my opinions became sharper. Not because I had more of them, but because I filtered them. Fewer opinions acted upon meant fewer mistakes to manage. That alone improved results. Trading is not about expressing yourself. It is about aligning with what is already happening. The market does not need your interpretation. It reveals its intent through price. Your job is to listen, not to comment constantly. When opinions stay in the mind instead of the market, they cost nothing. When they are converted into trades without confirmation, they become expenses that compound quietly until the account reflects every undisciplined thought ever acted upon. Overtrading is not aggression, it is leakage. A slow drain caused by the belief that every idea deserves a chance, when in reality, most ideas deserve to be ignored. The trader who survives longest is the one who learns to separate thinking from acting, who allows opinions to exist without immediately funding them, and who understands that restraint is not passivity but protection. The market pays patience, not participation. That truth stands in quiet opposition to everything a new trader feels. When the screen is moving and prices are printing, it feels natural to believe that being involved is the same as being productive. But the market does not reward presence. It rewards timing. And timing has nothing to do with how often you show up. Participation is easy. It requires no discipline, only access. Patience, on the other hand, demands restraint, confidence, and the willingness to look wrong in the short term. Most traders would rather be active and uncertain than still and correct. Have you noticed how uncomfortable it feels to watch a market move without you? I once believed that if I wasn't in the market, I was missing something. That belief cost me more than any single loss ever did. The market is not a performance where attendance matters. It is an auction, and auctions only pay those who bid at the right moment, not those who raise their hand constantly. Patience in trading is not passive. It is selective. It is the decision to wait for conditions that justify risk. That waiting is work. It involves observation, judgment, and the ability to say no repeatedly without frustration. Can you sit through hours of movement and still believe that your best action is inaction? The market is open nearly every day, but opportunity is selective by nature. If it were otherwise, everyone would succeed. The scarcity of true opportunity is what gives it value. Yet most traders treat the market like a buffet, filling their plate with whatever is available instead of waiting for the one dish worth eating. Participation gives the illusion of control. You feel engaged, decisive, involved. But that feeling is often a distraction from the fact that the trade itself has no real edge. The market does not reward feeling involved. It rewards being aligned, and alignment cannot be forced. Patience shows itself in how you handle boredom. Boredom is the market's way of testing your discipline. When nothing is happening, when price is chopping and volume is thin, the market is asking a simple question: can you wait without inventing reasons to act? Most losses come from trades placed during impatience, not ignorance. The trader knows better, but acts anyway. He participates because doing nothing feels like failure. But in trading, doing nothing is often the most profitable decision available. The market moves in cycles of expansion and contraction. During contraction, participation is punished. During expansion, patience is rewarded retroactively. The trader who waited through dull conditions is already positioned when the move begins. The trader who stayed busy is usually tired, distracted, or on the wrong side. I learned that patience is not about waiting for perfection. It is about waiting for clarity. When the market is clear, decisions become simple. When it is unclear, activity only increases confusion. Why trade when the market itself is undecided? Participation without patience leads to overexposure. Too many trades, too much risk, too many opinions competing for attention. The account becomes a battlefield of small decisions instead of a place for decisive action. And small decisions, repeated often, tend to be expensive. The market does not measure effort, it measures results. You are not paid for screen time. You are not rewarded for analysis alone. You are compensated only when you act at the right time, in the right direction, with the right size. Everything else is preparation. Patience also protects your mindset. When you trade less, you think more clearly. Losses don't stack emotionally. Wins don't inflate the ego as quickly. You begin to see trading as a business of waiting for favorable conditions, rather than a game of constant engagement. Participation feeds impatience. Each trade creates a desire for the next. The mind becomes restless. The need to be right increases. Patience breaks that cycle. It slows the process and restores perspective. I found that the more patient I became, the less personal trading felt. Price movements no longer felt like invitations or insults. They were simply information. That detachment is impossible when you are constantly involved. The market does not care how long you have been waiting. It does not reward loyalty. It rewards readiness. And readiness is the product of patience, not participation. Many traders confuse patience with fear. They believe waiting means hesitation. But hesitation comes from uncertainty. Patience comes from confidence. Confidence that when the right moment appears, you will act without doubt. Participation often comes from fear of missing out. Patience comes from understanding that missing bad trades is just as important as catching good ones. The market will always offer another opportunity, but capital does not regenerate as easily. When you stop needing to be involved, you start seeing more clearly. You notice how often the market does nothing of importance. You see how much movement exists without meaning. That awareness changes how you value your capital. The market pays patience not because patience is noble, but because patience aligns you with reality. Reality does not rush. It unfolds, and those who wait for it are already ahead of those who try to force it.